Welcome to the second in our series of tutorial videos about Curie, Perpetual Protocol's decentralized derivatives exchange. In this video, we'll provide a walkthrough of how to use the brand new multi-collateral feature so you can start trading or market making with Ethereum. So up until recently, the only asset that could be used to trade or provide liquidity on Perp was USDC. But with the multi-collateral release, you can now do the same with ETH or wrapped ETH. To learn more about the concept of multi-collateral and DeFi, check out our Learn article, which is linked in the description below. The major benefit of multi-collateral for LPs and traders on Perp is that they can maintain upside exposure to ETH, all while having a leveraged position or providing liquidity in any of our markets to earn a yield. Here you can see two figures of interest displayed on the UI, the net USD value, which is the total market value of your deposited assets, and your account's free collateral. These two values are equal since we have only deposited USDC. Clicking on the tooltip, we can see that the buying power is 10 times the free collateral value when just using USDC. The chart here shows an example of how margin works when only USDC is deposited. Assume you open a long position of 1 ETH at an entry price of $100 and you have 50 USDC as collateral. The free collateral after opening the position is $40 since only $10 of the balance is needed as margin to achieve a buying power of $100. When the price of ETH rises, the unrealized P&L increases as does the account value, but the free collateral remains constant. Unless the position becomes unprofitable, the free collateral remains at $40. Only once the position is closed are the profits realized from a trade added to the free collateral. But what if you want to use collateral other than USDC? Things change slightly as a weighting system is applied. The weight for USDC is 100%, while for ETH or wrapped ETH it is 82.5%. Here you can see we've deposited $20.9 of Ethereum, but the free collateral is only $17.2, which is 82.5% of the deposited amount. Now let's look at the same graphical example as before, but starting with $50 of Ethereum and no USDC. Notice that the main difference here is that your free collateral rises as the price of ETH rises, even when you have an active position. When opening a 1 ETH long position at $100, the free collateral was $31.25. Since settlement is in USDC, as the price of ETH rises, you'll need less and less ETH to maintain the position. For example, when the price rises to $120, the free collateral rises from $31.25 to almost $40. When using ETH as collateral, every 10% price move in ETH leads to an 8.25% change in free collateral and an 82.5% change in buying power. Now we'll open a position in the Bitcoin market using Ethereum as collateral. But since everything is settled in USDC, once you've opened the position, the USDC balance will turn negative. The negative USDC balance can turn positive again once you close a profitable trade or earn enough fees from providing liquidity. Alternatively, you can deposit more USDC to your account. If you have a negative USDC balance, then non-USDC collateral such as ETH cannot be withdrawn. However, your total collateral, free collateral, and buying power are unaffected. You can find out more details about multi-collateral on Perp through our help center, which is linked in the description below. As well as a position liquidation process, there's another process called collateral liquidation. These collateral liquidations will occur to convert ETH or other non-USDC assets into USDC when any one of the following three conditions apply. First, if the margin ratio falls below the maintenance threshold of 6.75%. Second, if the USDC debt is greater than the non-settlement token value times 0.75. And third, if the USDC debt is greater than $10,000. If you plan on using non-USDC collateral to trade or market make, we recommend that you deposit some USDC to cover the trading fees, funding payments, and any negative P&L. When using both ETH and USDC as collateral, the same collateral liquidation process applies. The liquidator smart contract will determine which collateral will be liquidated in no specific order. If you navigate to the history page, you can view any collateral liquidations, as well as other details such as the liquidated amount, the USDC received, the insurance fund fee, and the liquidator fees. So now you know a bit about how multi-collateral on Perp works. Let's look into one strategy that it enables. You'll notice here that the Ethereum market has a positive funding rate, meaning that longs pay shorts. Therefore, you can use ETH to capture this funding rate when shorting the ETH USD market to earn funding payments. To earn funding payments while being hedged, you can swap USDC for ETH using a spot exchange such as Uniswap. In bullish markets, you'll be paid a funding rate to short ETH, while the spot holdings and the ETH you're using as collateral for the short position on Perp will negate the loss of this position. Once your ETH short has been open for a while, you can check your funding payments by clicking on Funding Payments History in the Positions tab. And there you have it, an overview of multi-collateral on Perp. Stay tuned to our Twitter and subscribe to our Medium blog, as we'll be adding new assets that can be used to trade or market make in the near future. If you have any questions, you can join our Discord and we'll happily help you out. Don't forget to like this video and subscribe to our channel for more trading and cryptocurrency related content. Until next time, bye bye. Happy trading, creating and market making.